In Leftskewed Investment Management, portfolio land up 55% year to date, et cetera, et cetera, et cetera. We're engaging in a small short-term pivot without majorly deviating from our cautious course existing right now. We're going to explain that logic. Once again, I apologize for the weird setup. You might see some stuff in the background. We're still in the move-in process that will hopefully be completed soon. We're going to have our lighting back soon. That stuff's in my car, which is in the shop, et cetera, et cetera, et cetera. So let's get into the portfolio makeup. What are we doing? What's the pivot? So we've been calling for a bear market rally. We've been positioned as such. We've been seeing that come to fruition. However, today it occurred to me after seeing tremendous gains that, wait a second, the White House said the jobs report, or jobs are going to slow, rather. And they've done this on inflation. They've said inflation's going to come in hot, inflation's going to come in hot, and they haven't commented when inflation is less bad than expected. So the fact that they are commenting, I think, is a little bit of an important hint that we have to note that jobs are going to be slow. Now, the market was down today this morning because there were less unemployment claims. I don't necessarily think that, at least yet, at least today, at least last week, whatever, that there's a massive layoff unemployment spike. We'll get to the layoffs thing later in this video. But it seems like tomorrow we might get less hired than expected. Just simply less hired. There's not that many people available left. We'll just simply get a little bit less hired. Non-farm payrolls. Okay, that's fine. We'll see how that is. If that comes in lighter, the market can rally. The market can rally for kind of stupid reasons because they say, oh, look, the labor market isn't so hot. The Fed doesn't need to be as hawkish as long. Fine, so be it. We took off some short-term, downside protection, some short-term puts, some shorts on Tesla, on the TQQQ. We took those off. We've still got some SQQQ. We've still got some Tesla short via TSLQ. We still think the market pulls back. But if there's a bounce from 3,900 to a little over 4,000, why not try to maximize those gains? Why are we just going to hold through that if we see that there is a bounce coming, right? When you're not so sure, all right, fine. You sit through the pain, the pains might come, and you just deal with it. Here, we feel pretty confident. Okay, after 5 days in a row of red, there might be a catalyst for some green tomorrow, and we're not typically short-term traders, but we go with the flow. And right now, this is what the flow is giving us. We're adapting to that. We're playing that, and we're trying to make money off of it. So we're taking down some shorts, not 100% because we're not betting the farm here, but we're taking some shorts off, mostly just taking shorts off. We put on one very small, very, very small, like 0.3% size call option, 0.3% on a company you've never heard of. And we'll see what happens tomorrow. Maybe we're wrong. If we're wrong, we're not going to get burned from this. But we're just letting you know this is a pivot and this is how we're dealing. However, not everyone here watching these videos is actively trading every second of every day and trying to make decisions every second of every day. So what do they do if they want to play the longer game? My opinion is be cautious. Stay cautious, because I think the peaks of the previous bear market rally, we'll call it, of the roughly 4,300 level, we're too close to all-time highs. We're too expensive. There are many stocks that are too expensive even still. We still had the short on Apple, even though we're using an iPhone. I use a Mac to go on my laptop, et cetera, et cetera, et cetera. Parts of the market are still too expensive, and the economy is not so strong. There are parts of the economy that are certainly weakening. There's a lot of parts of the economy that can weaken further. Credit card usage is going up. That's not so good. That's not happening because consumers are wealthy and they deserve more credit. That's happening because inflation is up and people need to use credit cards to pay for gas, which I know is coming down, but just wait a couple months. To pay for food, which is up. I know some parts are coming down. I don't think there's a massive deflation that's going to occur, okay? Deflation can occur when unemployment is tremendously high. Productivity is down. So where are all these supply gains coming from? Yes, maybe we're not in the depths of the pandemic where toilet paper is difficult to come by, but we're not firing in all cylinders, okay? The engine is operating, but there's a misfire, okay? You could still drive on a misfire, but it's not the same. You're not going to be getting maximum power. So I think we're in one of these positions, and the problem with the misfire is, yes, it's okay to drive for a little bit, but if you're not getting your oil changes, if you're pushing that engine too hard, it's going to cause a bent rod. And once you get a bent rod, just happened to me, just happened to my engine. That's why we don't have the proper lighting. That's why we're missing a couple pieces of art in this apartment. Well, the engine is going to be toast. And you can't drive on an engine that's toast. Not anymore. It's not just a misfire. It's a total catastrophic engine failure. So I'm not saying we're getting to that point with the economy. What I'm saying is there's definitely a misfire. There's definitely some reason for concern. You know, we're stimulating more. Inflation Reduction Act. We'll see what happens. I think there's reason for concern. I'm staying concerned. If there's a big rally here, I'm not buying that much stuff to go long yet, okay? What I'm doing is I have sold downside protection. I have cash. I plan to add downside protection if we see a couple green days here and get above the 4,000 level, because I think the stock market is more appropriately priced in the 3,000s. That's what I think is fair value. I don't think fair value is above that. I mean, just one last thing. I get it. Earnings are holding up. But you know what's not holding up compared to previous? Growth rates. Okay? Wasn't everyone calling Apple a growth company? Wasn't that a thing? Oh, Apple's a growth company. Does anyone know how much they grew year on year last quarter? It's something like 2%. That's less than the rate of inflation. I'm sure there's more specifics. I don't have all the specifics offhand, but I remember when that earnings report came out, my takeaway was, the earnings were actually much more solid than I expected, but their growth rate is not enough to warrant this multiple. If you're going to be trading at a 25 plus multiple, got as high as 28, I believe, you better have a good growth rate. I get it. Things are not super catastrophic, but they're not growing. This is not an engine under tremendous acceleration. This is not a Formula One race. We've had those, certainly, before. We had 4 years of that, as the Fed continues to mention, after the Tax Cuts and Jobs Act of 2017. We had that for a little bit after the pandemic, once the stimulus checks were flowing, and all of that. But now, we have a misfire. And when you have a misfire, you better treat it. You better be careful. And right now, I'm not really seeing a whole lot of treatment. I'm seeing some signs of something, but the misfire is still there. And it might be spreading. So, it's possible it gets revived. I don't know. I'm not a mechanic. We'll see what happens. That's today's video. And until next time, peace out.